The market has started to recover a lot of the losses that we saw in the S&P just yesterday. However, when we take a look at the REITs, we can see that industry over the last month has started to come down. In fact, we have the likes of Prologis down 6%, American Tower down 7%, Realty Income down nearly 5%. And with earnings coming for these REITs over the next few weeks, today we want to understand, is Realty Income, the monthly dividend paying company, sitting below $60, an undervalued buy? Now we're going to run through this company, a lot of information, and get to our own valuation model. But what we noticed, all three analysts, Seeking Alpha, Wall Street, and Quant, do believe this should be in the portfolio. Now it pays a dividend every single month at 5.35%. And as we notice, in fact, it is trading around the midpoint of the 52-week range. So we're going to get into it. Before we do, a few things that we do want to make you aware from their latest investor presentation that we saw in August. Now the first one is, if you are investing in this company, management believe you are getting around an 8 to 11% return on your investment year on year. The way they've broken this down, well, that's 6% in a dividend or thereabouts, depending on where the share price lands. Then you have around 2% in the internally generated AFFO. Now that stands for the adjusted funds from operation, and around 2 to 3% from the externally funded element of this, which will be reflected in your return. Thinking about this company over longer term as well, we can in fact see they've purchased 82 assets across 5 countries for $527 million, and in fact one of their tenants is the world's largest sporting goods retailer, Decathlon, and something we will come to show you, they are moving into new countries. As we can see, their investment thesis alone talks about continental Europe, France, Germany, Portugal, as well as the other countries that these assets are already held. So Realty Income, you may think of it as just solely the US, but they're also expanding their international portfolio. And a few things that we like, since their listing in 1994, the annual total return has been 13.5% year on year. They've increased the dividend year on year around 4.3%. That is around that 4% minimum inflation target we have, which is nice to see given the dividend they pay is around the 5 to 6% level. And 27 out of the 28 years, they have reported positive EPS growth. So that is very strong, lots of positive metrics for this company. And in terms of those that are maybe newer to this Realty Income portfolio, we can see their top 20 clients are made up of some companies that we have seen some bearish indicators from, but we've discussed these in earlier episodes. We have Dollar General at 3.4%, Walgreens at 3.3%, Family Dollar and Dollar Tree at 3.1%, and 7-Eleven at 2.6%. Now they are very proud, they talk about industry diversification and it is spread across a few others, although some people do argue these are very similar. We also notice that international expansion, as we just mentioned, the UK portion is around 11.2%, but we can see the vast majority of this is made up in the US. Now we've been talking a lot on this channel about the weakening consumer environment. However, Realty Income do believe that even if the consumer behavior does change, a lot of their clients are targeted in different areas. We have non-discretionary, service-oriented, low price point as well as non-retail, which they do believe give us a little bit of a cushion if there are any worsening of this environment that we are starting to see. And they do continue to increase their presence in Europe, as we can see around 11 billion up until June of this year in terms of how much they are putting in, and we do expect this to continue quarter on quarter. We will be excited to see in their next investor presentation if they have made any other additions. We also note in terms of the actual portfolio itself, we have some very large companies here that I'm sure a lot of European listeners will know and can attest to. And the final thing that we want to show you is that their guidance that they did release from their latest earnings, the main thing to point out here is that they did lower their net income per share, although marginally, to 121 to 130. But the one thing we do love to show and re-emphasize, their overall occupancy is over 98%, and they do expect this to continue for the full year of 2024. Very important, we don't want to see any issues with any of their tenants. One thing you may not know about this company, they do hold a fair amount of debt, around 26 billion, but 94% of that is fixed, and that is fixed in terms of a weighted average of around 3.9%, with essentially maturity of 5.6 years, with the expectation that the inflation rate is going to come down over the next 4 to 5 years. Interest rates we do believe will follow, and when they do come to essentially refinance the vast majority of this debt, we expect it to be around this level, if not even lower. Variable debt only makes up around 6.3%, so just mentioning that to take consideration of any people that are worried about the amount of debt they hold. Now, they continue to increase their dividend. The more recent one we actually saw on the 10th of September, and that is a 127% dividend increase from Realty Income. They typically increase the dividend a few times every year, and if you want to see it in a graphical basis, you have to excuse the quality. This has been taken from their website, but we can see every single year that dividend has increased, and these are the numbers here, if you are able to see this, of how many times they increase it during the year. Just in 2024 alone, they have increased it, although fairly marginal, 5 times. So looking back at this company, we can see over the last month, it is down around 5%. Year to date is up around 4%. Over the last 12 months though, it is up 26%. Over the last 10 years, up only 27%. Now that doesn't include reinvesting the monthly dividend, something we will come to look at and compare against the S&P. But we also noticed it hasn't recovered from the highs of February 2020 at $82 just before that massive COVID drop. Something to bear in mind whether or not we will be able to see that in the longer term with the rates coming down. We've already mentioned it is trading in the mid to perhaps upper end of the 52-week range. P to FFO, funds from operations, around 14. We'll compare that to the sector. The yield, 5.3% paid every single month, and a triple buy rating right across the board. Now, in terms of their expectations moving forwards, they are expecting growth to the EPS year on year. Some years low, some years high single digit, and some years double digit growth. Although when we do look back over the last 4 quarters, they have in fact missed half of them, 50% track record. More recent quarter though was a beat. In fact, over the next full year, 4.42 funds from operation estimate, lowering the forward P to FFO around 13.42. Now let's take a look at some of their metrics. Now, dividend safety score, always important to look at for a company that pays every single month, sits at 80, double undervaluation signal that we'll discuss, and over the latest year they have increased the dividend around 3 to 4%. Now, dividend safety was reaffirmed in August this year. Effectively, a dividend cut is unlikely for Realty Income. Now, how do they perform in the last recession? So these are key metrics from the 07-09 crash. They increased the dividend, great to see. Pretty much flat sales, above the average of the S&P's -12, and they did outperform, although marginally, -43%, S&P -55. Now, over the last full year and the last 5 years, they've increased the dividend by around 3%, marginally lower than inflation historically. Over the last 20 years, marginally higher at 5%. And we can in fact see they are a dividend aristocrat. They've increased those dividends more than 25 years year on year, but they've also been paying a dividend for the last 55 without a reduction. Now, in terms of this valuation model, remember we will come to our own model, we can see for the vast majority of the last year, it has been undervalued below the expected fair price. Right now, we also see that trading towards the lower bottom. So this means this company does look undervalued. And this is re-emphasized when we look at these two models. Dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. That is another undervaluation signal. And here we see forward P to FFO 14 below 17.1. And we also notice it is lower than the real estate sector at 16.5. So undervaluation all across the board. But remember, we don't look at any one of these models in isolation. We will conclude towards the end of the episode. Now, as always, we do like to focus on free cash flow, but it is a lot more volatile, essentially, for REITs. So we focus on adjusted funds from operation. Below 90% is what we want. That is what we get, and it has been decreasing over the last 10 years. 76% in 23, 74 expected over the next 12 months. So that is a good sign in terms of the health of the overall dividend safety. Then we get to the AFFO per share. Similar to the free cash flow, we want consistent increases over longer term. That is what we get and anticipated to continue over the next 12 months. And then when we get to the sales growth for REITs, 5 to 10% for steady moderate growth. We see that every single year, if not a lot better, 28% on a trailing 12-month basis. And one thing very important to look at with REITs, their adjusted funds from operation per share growth. And we notice some years in the mid-single digit, some years low, some years high. 2% in 2023, expected 3% over the next 12 months. And remember, we did talk about this in one of their investment presentation slides. They expect, including the dividend yield, to return above that 10% point. So in terms of total sales, well, they have pretty much quadrupled it from 1 billion in 2014 to 4 in 2023. But one thing we always have to highlight with REITs, and in particular Realty Income, they do dilute your position over the longer term. And the reason why they do this, as we can see, they don't retain a lot of that internally generated cash flow. They pay a significant amount in dividends. Realty Income, unfortunately, are one of those companies that do dilute your position at a much faster rate than other REITs. Something, as we said, just to focus and bear in mind. ROIC, now for REITs, 3 to 5%, other companies 10%, to ensure management are effectively allocating their capital. Now 2%, very low in 2021, is increased over the last few years at 3%, so not bad, just something to keep an eye on. We do want to see it back to the 4% level for the majority of the last 10. Then we get to the operating side, looking fairly healthy over the last 10 years, around the 40 to 50% point. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 5.5 is what we want to see. We don't really get that. In fact, 6.05 in 2023. And for those that don't know, these numbers signal the number of years it would take the company to pay off all of their debt net of cash on hand. And this metric, very important because it does correlate to both balance sheet strength, dividend safety. Positive to note though is over the next 12 months, they are expecting it to come down to 5.18. So looks good. Let's hope they can execute on that. But that is something definitely to bear in mind as an investor of Realty Income. Now we want to let you know we have released our latest article running through undervalued stocks to buy for the month of November. And every week we do send a free article Monday morning to your inbox where we talk about what's happened in the market as well as severely undervalued stocks for your own portfolio. So do click on the pinned comments, sign up, and you can read straight away. As we said, you can gain access to the November undervalued stocks. Lots of information for each one, as well as the upside that Wall Street see over the next year. And you will also be able to grab 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P right now for the next year. As we said, click on the pinned comment below, sign up, and you can read straight away. Now, other parts of our analysis include insider ownership, which sits at 0.1%. We see around $900,000 worth of sales over the last year. Nothing in Q4. In Q3, we see 411,000. When we take a look at who these insiders are, well, first thing to note, a little bit outdated, 11th of September, and as we can see, $100,000. Information is there, but as always, insider selling, we don't consider it a bearish signal, but then again, transparency if you do want to conclude. Institutional aspects, well, 71%, $1.5 billion worth of sales over the last year, significant amount more, nearly 3 times during the same time frame. And what we notice in Q3, the more recent quarter, institutions are buying a lot more than they are selling. So overall, they're still very bullish on Realty Income, but as always, do your own due diligence, never copy what they do. In terms of the income statement, well, we've already seen the revenue. As we mentioned, it has quadrupled over the last 10 years, going from around 1 billion in 2014, 4 billion in 2023. But we want to flag the bottom line net income. Does it follow a similar trend? Well, what we do notice, it is very inconsistent over the period. So something to bear in mind, perhaps in your investment thesis, it's gone from around 271 million in 2014 to 872 in the latest year. So it has been increasing, but very, very inconsistently. Then we move to the health of the company, total cash versus total debt. Again, this metric is very, very inconsistent, going from 4 million in 2014 to 443 in the latest quarter. And what we want to focus on here is comparing it to their total debt numerically and directionally. It has been increasing quite significantly, although something we do expect for REITs. Again, bear this in mind, we did see the net debt to EBITDA fairly high consistently. Debt's gone from 5 billion in 2014 to 26 in the latest quarter, so we can see more than 5 times growth to that figure. Now let's get on to some gradings. First one, valuation with a B-. Now typically we look at the forward P, however for REITs we don't look at these metrics, they're not relevant. We focus on the price to adjusted funds from operation. Sits at around 14.1, we already mentioned this. Sector medium does sit higher at 16.54. So right now, if you are adding Realty Income to your portfolio, you are getting a 15% discount to the overall market. Does Realty Income deserve to trade at a discount? Yes, no, something to consider, but we will factor this in to our valuation model and our margin of safety. Growth grade, well, they get an A+, lots to love here as we can see. Operating cash flow has been growing year on year, 17%, much better than the sector at 4%. Again, forward looking, 16.5%, much better than the 5.18%. When we take a look at these others, we have discussed the majority of these. Consecutive dividend increases, as we said, dividend aristocrat, and all of these in terms of the EBIT growth, EBITDA growth historically and moving forwards, looking significantly better than the overall sector. So you could argue it actually maybe should be trading at a premium and not to a discount. Then we get the profitability where it sits at an A. In fact, it does look very good. Their cash from operations, 3.3 billion. The sector overall, 237 million. And their EBIT margins also looking good, getting an A and A+, given it is significantly better than the sectors that we see respectively. So overall, it is looking very strong. And in fact, when we do come and do a quick summary, we can see a triple buy rating across the board, B- valuation, A+ on growth with an A on profitability. Now, before we jump into our own valuation model, let's compare the performance against others in the industry. Simon Property Group, Kimco, some other very, very big names. Over the last year, including dividends reinvested, this pretty much tells us, with Realty Income being in the middle, that the whole sector has performed very, very strongly. Should this continue with rates coming down? Something to consider. Over the last 5 years, though, when we do take a look, if you were to continually reinvest those dividends month on month, your position would be lower, -5%. And we can see some of the other REITs have also faced a similar fate. Over the last 10 years, though, with reinvesting those dividends, they are the best out of the competitors, up 107%. Whether or not this is something you would like for your investments, always remember that past performance is not an indicator of the future. And when we come to compare it, well, over the last year, it has only marginally underperformed the S&P, 32% versus 36%. When we look over the last 5 years, not only has S&P massively outperformed, but as we discussed, Realty Income, -5%. Over the last 10 years, S&P has massively outperformed. Now, we do understand, while we do ask this question about whether you believe it will continue to outperform over the long term, that people may invest in this company for a different reason. They may want that yield, the 5-6%, and use it on their own personal expenses or for whatever reason. So there is lots of other things to consider with this company. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $69, the average of these three models. Now we'll go through each one very quickly. We have the multiples valuation, companies in a similar sector and size that we analyze. Their P to AFFO, average P to AFFO with that of Realty Income to give us an intrinsic value showing massive undervaluation at 78.34. We then move on to the dividend discount. As we saw, the average growth rate around 3 to 4%. Moving forwards, we've gone not far off at 3.25, which is lower than the last 2 years. We get another undervaluation signal with intrinsic value of $67. We then have the free cash flow year on year, average at 21%. We've gone a lot lower at 8%. With the discount rate, we've got the present value of future free cash flows at terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see, a marginal undervaluation signal, giving us the average $69. Now the current price around the $59 mark. We always like to use an MOS on this channel, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, well, a buy at $62 in today's episode. Then we keep going till it's near the current trading price. So what we're saying right now, we see Realty Income 15% MOS at today's price. Wall Street, we got a triple buy rating, their price $66. They see upside of 12%. But for those that want to see a larger MOS, well, at 20%, you'd have to wait for $55. At 25, around 52, and at 30%, around 48, and that is something we did see over the last 12 months. So in conclusion, Realty Income, 15% MOS, 12% upside over the next year. Whilst we understand investors may buy this for other reasons like using the yield, give us your thoughts below. Is this a buy, hold, or sell? Don't forget you can also grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Realty Income or any others. And if you did enjoy the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.